Welcome to the Retirement Outsiders Podcast. I'm your host, Steve, and I'm joined by my wife and co-host, Tony. The focus of this podcast is to discuss various retirement topics from an outsider's point of view. In terms of this podcast, an outsider is someone who is not retired, someone who is not a financial advisor, someone who is not a CPA, lawyer, or healthcare advisor. I'm an engineer, and Tony is a teacher. We've been preparing for retirement for several years. We've encountered many different opportunities and obstacles throughout our careers and our paths to retirement. Early on, so much of it was intimidating. Our intent is to make some sense out of all the financial, accounting, estate planning, and healthcare jargon from an outsider's perspective. In addition, we will discuss some of the behavioral aspects that come with not being tied down to a 9-to-5 job. Welcome to the Retirement Outsiders Podcast. Welcome to the Retirement Outsiders. Good morning, Tony. How are you?
I am very excited because we have a new neighbor.
We do. We have a swan out back.
We have named him Herzog.
After world-famous St. Louis Cardinals and other baseball coach, Whitey Herzog.
Yep.
In honor of Mr. Herzog.
I'm hoping he finds a mate and stays all summer.
That would be nice, yeah.
Geese are
Keep
just
the geese out.
Not coming over.
Well, in addition to Swan Talk, we're also going to talk stocks, mutual funds, ETFs, target date funds, and just in general how the stock market works.
Which I think a lot of people are interested in. Yeah.
Yeah, for sure. It can be very confusing.
Yeah. If those first stock mutual funds, ETF stuff intimidated you, I think the thing to hang in for is how the market works. If you're a little illiterate when that topic comes up, Steve's got your info.
Like some of the history and how and why we have all these different options today will make things make more sense. So today, it's free to buy or sell any kind of stock or fund online that you want. In fact, it'd be harder, I think, to find a brokerage firm where you would have to pay. It's super fast, easy, but that wasn't always the case. And as a result, many of us suffer from a limited knowledge when it comes to the stock market, I think.
I agree.
Back in the day, if you wanted to buy a stock, you needed to know a stockbroker.
Right.
Get affiliated with a stockbroker. You would pay the money. You would write a check. You might even get a paper copy of that stock.
Yeah. And I feel like Gen X and older, those generations, it was a process. And so that's always been in the mind. So unless you had an actual interest in finance and in those things and you did your own research, I think a lot of people are just intimidated and just never really delved into it.
Well, it was a lot harder to do, but it was also a lot more expensive. It used to cost you just a certain amount of money to buy or sell any amount of stocks. When I first started buying and selling stocks, it would be $10, $20 a trade.
This was in the 90s?
In the 90s, late 90s. So think about it. Let's say you're a young person or you're just new to investing and you wanted to start to learn and you thought, well, I'll put just a little bit of money in there. That way I don't lose a ton if I don't know what I'm doing. If you wanted to say, invest $100, well, if it cost you $20 to do that, you lost 20% right away.
Yep.
Now, if you invested $1,000 and it cost you $20, okay, it's not, you don't have to recover that much, but it was definitely a large barrier, especially for normal, average, everyday folks. And oh, by the way, their kids. We teach our kids all these things, but there was this huge barrier called money, fees, to delving into the stock market that people just didn't do it.
Something that I learned through my teaching career is I taught a personal finance class, and part of that curriculum was I had to teach about stocks and investing. And I discovered that there are fantasy stock market trade leagues. So you can do what is that? Imaginary stock market trading, but it's real time updated stuff. And man, high school kids really got into that. And I have students, not today, but probably up to 5 years after I taught them that class, emailing me questions and things. And what was that website again? Like they maintain that interest. So I think the natural inclination is when you realize this is doable, it's something that is accessible. It's something that's not like our mom and dad's stock relationship.
So the issue back in the 70s, 80s, when fees were high and it was difficult, there was a border to get into investing, just because if you had that small amount of money to invest, the fee was a big percentage of it. Lots of folks would get together and create investment clubs.
Mm-hmm.
In fact, one of my uncles did that for years and years, I think 10 years or more, with a group of friends. They were all interested in the market. This is pre-internet days. So they would get the newspaper in the morning, check stock prices. It'd all be printed off in just about any newspaper that you would ever want to.
That's how you kept track of it. Yep.
Yeah. You might have a subscription to the Wall Street Journal. That was the reason for that magazine. Essentially, was it delivered the price for every single stock that was bought and sold, so that you could follow up. Now, most local papers would just have some subset of all those stocks, but that was a way to get past that high barrier of the fee being such a high percentage of how much money you had to invest. If you have 10 friends and you all invest the same amount of money, now your percentage of that fee goes way, way down, so that it might make a lot more sense for you.
Kind of an in-person mutual fund, right? Everybody's deciding on what they're going to be investing in.
Yeah, and you can write up the rules any way you want. I mean, theirs was very formal. They had a signed documents and I don't know.
Which is smart, honestly. When you're dealing with money, especially if you do really well and it becomes a lot of money, and not everybody's in the same financial situation, that makes sense.
And if I remember correctly, they had a voting structure. I don't think it was unanimous on every purchase or sale, but it was, they had some kind of agreement there where, they made those decisions. But it's just a really kind of cool, interesting way to not only make the fees more reasonable back then, but also a great way to learn, because each person was in charge of going and studying certain stocks, certain sectors, and they would come back, meet, monthly, and present to each other.
Right, probably monthly.
I think it was more than that. And it's super easy now to invest in the market, to buy stocks, funds. You can do it on your cell phone. You can do it while you're sitting in class or sitting at work. The trades are free. It's very simple to do. So we went from very difficult to do and expensive to very easy to do, very cheap. But the gap really is the knowledge. The knowledge hasn't caught up, because people that are parents now of young people, they're really the first generation of folks who have gone through the stock market where it's been easy and cheap to invest. So those people, it's sort of the first generation of normal, everyday, average people that have had an opportunity to really start to learn about the market. So I think every generation that comes by, I think that knowledge base hopefully will increase quite a bit.
I don't know. I feel like you and I joined the stock market knowledge grab during just a magnificent time, and that was during the internet boom.
Well, that's true, but I think there's another thing that helped me, and I would equate it a little bit to the way I've learned computers. So when I started learning about computers, I was in middle school. We had an Apple computer with Oregon Trail on it.
Yes.
I think a lot of us probably had the same experience, but it's
like
not
we
like
should take a break right now so I can go play that and die of dysentery.
Yeah. So it's not like you learned a ton from that, but at least you got introduced to it. My parents never saw that, right? So there was an introduction. Then in high school, we got the first word processors, so I learned a little bit of that. And then college, I worked on one of the very first electronic spreadsheets. And then, of course, due to my career, I've had to work on a computer all the time. I've learned along with the progress of computers. I've learned little bits and bits here and there as it's gone on a daily basis. So nothing ever got too far out in front of me to where it was very intimidating to try to learn it from the beginning. If I was to try to teach someone today how to use a Windows-based computer that had never used a computer before, I mean, where would you start? That'd be very difficult. But I learned all of those little things. Not that I'm some kind of computer genius, but I know my way around a computer very well. And it's because I've learned little bits and pieces as they've been introduced over time.
Yes.
And I think that's one of the difficult things about understanding and learning the stock market is there's so much stuff. But if you go back to the beginnings and try to learn it from the beginning and the how and why things changed, that'll help you make a little bit more sense of all the different options that we have today.
Okay.
So let's start from the very basics. So the stock market it's basically a big meeting place where people trade tiny little pieces of companies. When a company does well, those pieces tend to become more valuable. Prices move all day because millions and millions of people are constantly reacting to news and hopes and fears. At its core, it's just a crowd deciding what companies are worth from moment to moment. So why do companies do this? Why does a company release stock? Any clue?
Yes. I do know why. Companies release stock to build their cash flow. They want to expand. They want to turn their mom and pop organization, they want to turn their Amazon bookseller into a multi-product selling platform.
The way I look at it is these companies, they have people at the top that have great ideas, and all they need is money to unleash these ideas. But they don't have the money yet. So they release this stock. They quickly get an influx of cash so they can go and make stuff happen. Yes. That's how you grow quickly. So again, what is a stock? It's a single slice of ownership in one company. Returns come from price increases and dividends. A dividend is just a cash payment that the company makes to you. It's like a thank you. Thank you for investing in us. Here's some cash.
I still don't get those. And that's a conversation for a different day, but you've explained them kind of like icing in hockey. I've heard that explanation multiple times.
Dividends are easy. If I let you borrow some money and you went and made a bunch of money off of that, you could either my ownership, I own a percentage of your company because I let you borrow that money. You can either say the value that I own just increased by that entire amount, or you can say, for some of that increase, I'm just going to give you some cash today. Here you go.
But why? That's what I just don't. And
because
why sometimes
people like
and not others?
People like investment income.
Yeah.
It's an influx of income so you don't have to sell your stock to get cash back.
Okay. Okay.
So we'll continue here, right? So stocks, there's large, medium, and small cap stocks. What does that mean? That's just small, medium, and big size companies. Market cap means market capitalization. It's the total amount of money that the company's worth.
The net worth of the company.
The net worth of the company. You've got terms like the NASDAQ, the S&P, the Dow. That's where, and I'll cover that in more detail. Those are the stock indices, if you will. There's no fees anymore to buy and sell stocks, which is great. If you're,
is that across the board?
Well, effectively, yes. If you're buying or selling stocks and you're paying a fee, you're doing it wrong. And stocks trade essentially all day long. The stock markets in the United States are open from 9:30 to 4 p.m. Some examples of stocks, we're talking Apple, Microsoft, Amazon, Coca-Cola, JP Morgan, companies like that. All publicly traded companies.
So just let me see if I can stump you here.
Okay.
Give me a big company that's not a public company. Do you know of any?
Some big private companies, Northwestern Mutual.
Northwestern Mutual.
Big insurance company.
I think Little Caesars might be still private.
I don't know.
Okay. I think they
Not
are.
sure about Little Caesars. Okay, next up is mutual funds. This is where a little bit of the why comes into the thing. So what is a mutual fund? A mutual fund is a professionally managed group of stocks or bonds or both.
These
it
are
offers
generally what you're seeing in your 401k, 403b, correct?
Not necessarily.
Oh, I feel like, okay.
There's certainly options for those, but you can get those anywhere. You can buy mutual funds anywhere that you can buy stocks.
No, I understand that. I'm saying that in a 401k or in a 403b, those tend to be mutual fund.
Well, let's back up a little bit.
Okay.
Let's talk a little bit more about the why. So stocks, as I mentioned, if a stock costs $50, you have to have $50 to buy it. If a stock costs $1,000, you have to have $1,000 to buy it. If you have $1,100 and a stock cost $1,000, you can buy one share and then you have $100 left over. So if you were trying to invest $1,100, you can only invest $1,000. So mutual funds, one of the things that mutual funds do is they allow you to invest all the money that you want to invest. You can buy tiny percentages of these funds. So that's benefit number one, is you can invest all of your money. You don't have to buy it in chunks and share-sized chunks. The other big benefit for a mutual fund is that you can instantly diversify. So these mutual funds, they are going to encapsulate an idea. It's going to, some examples of some funds, the Vanguard 500 Index Fund, so that's like Vanguard has 500 stocks that they follow. So if you were to buy into that fund, you're buying a piece of all 500 of those.
I remember when I first invested in a 403b, that was my first job in a hospital. I chose the green fund. I was very excited because all the companies were considered environmentally friendly.
Well, that's something. So there's a mutual fund for every type of possible group you want to cut the stock market up into. It's little groups. It's teams. You can try to mimic the entire stock market fund. There's a Schwab Total Market Index Fund. You can look at just companies that you think are going to grow. So a little riskier, but the upside potential is much higher. You can invest in mutual funds that are made just to generate income. People like, we talked about dividends a few minutes ago. People like to invest in things that just pay them essentially a salary every month, every year. Mutual funds, again, what it does, it allows you to invest as much money as you want and as fractional amounts as you want, but it also allows you to diversify, and it gives some of that control to supposedly smart people who know what they're doing. If you're investing in a growth fund, you're just saying, I don't know what stocks those are. I don't know what percentage of this stock versus that stock I should get into. I'm going to let a professional handle this for me. I'm going to go to the American Funds Growth Fund because I've heard of these people and they know what they're doing. And if they have a growth fund, then that's good enough for me, right? Now, of course, all this doesn't come for free. Mutual funds have fees. And there's different fee structures for mutual funds. You got to pay these people to do all this homework.
Because those mutual funds aren't set. Most of them are managed, and some of them are managed daily, right?
Of course, yeah. They're buying and selling things sometimes daily, but on whatever time frame makes sense for sort of the mission statement of that fund. You'll find a paragraph or several for every fund, and it'll walk you through, hey, this is what we're trying to do. This is the risk profile. This is what you can expect us to invest in. And of course, you can look at historic data for how well the fund is done. Now, one of the nice things, I'll say it this way, one of the nice things about the fee and how the fees work, the fees are taken out without you really seeing it or noticing it. So when you look at the historic returns on a mutual fund, if it tells you, they made X% over this year, that year, these 3 years, these 5 years, That includes the fee they've taken out. And they're essentially taking a fee every single day. It's not like once a week, once a month, all of a sudden you see a dip in your account because now they're taking their fee out. It's built into that performance. So some people will be very intent on looking at what are the lowest fees for a mutual fund. I want a cheap mutual fund. To me, the smarter way to look at it is
what are
compare the returns because the fees built into there.
Yeah.
I don't care what fee you charge me. I care about the end bottom line result, and that's what those show.
Basic math. Let's see.
Exactly.
Am I getting my investment of fees worth of payback?
Exactly. One of the things I don't like about mutual funds is that there's no intraday trading. The prices are updated once a day after the market closes, and sometimes several hours after the market closes. So you don't really see it moving up and down. Now, if you're buying a mutual fund that, mimics a certain sector, and you see, whoa, that sector is down, or one of the big players in that sector is down, you sort of know your mutual fund's going to probably lose money that day, but you don't see it until the end of the day.
Yeah.
And I don't, in our culture of needing to see things immediately, it bothers me a little bit, especially since there's other options. Also, you can't just sell them. They don't sell during the day. They establish a price after the market closes. And then if you had said you wanted to sell that day, then they sell after the day's over at that set price. So essentially, every stock that makes up that mutual fund has to clear for the day. Then the mutual fund people look at all those stocks and say, okay, I guess this fund right now is worth X because all the stocks that are inside of it have finished at this particular number.
Okay.
Makes sense. So that's why it takes some time. There are tax implications as well because you're actually... The manager is actually buying and selling those stocks within inside your fund. So you can have capital gains and things of that nature that you're going to have to pay at the end of the year. Now, so why do we need something else? The next category is ETFs, or exchange traded funds. Similar to mutual funds, but they trade like a stock. So they trade intraday. Thing that they're trying to do is track an index. So, for example, an index would be the S&P 500 or the NASDAQ. There's more nowadays, but where they really started was there was a desire. People wanted to buy or invest in the S&P 500. They didn't want to buy 500 stocks. And there weren't really mutual funds that just tried to follow those indices. They were more about sector-based management. So ETFs come along. They have relatively low fees because they're not a creation of a company. They're trying to mimic something else, which is, I suppose, theoretically much easier to do. They trade, like I said, they trade like a stock, trade intraday, and there's much fewer to no tax implications. So you're not having to pay when the mutual fund company buys and sells stocks inside the mutual fund. The S&P, you own it. You own that ETF as a proxy of the S&P 500. So you're not owning something that in itself is buying and selling stocks. So there are no tax events that happen inside an ETF in general.
Okay.
Does that make sense?
Yeah. I mean, it's the stick figure that I can understand. I've heard you go into this in more detail before, and it becomes Charlie Brown's teacher.
Well, to try to make it simple, mutual funds and ETFs, both chunks of stocks. Mutual funds, you're paying a smart person, you're paying a company to put a package of stocks together with very specific purposes. With an ETF, you're buying a product that's trying to mimic something that's already created.
Okay.
Next up is target date funds. You may have heard of these target date funds. They are very prevalent in retirement accounts like 401ks, 403bs. Why do we need a target date fund and what is it a target date fund essentially is a one-stop shop retirement fund where you can say, hey, this is the year I plan to retire roughly. So I should buy a fund that has that year number in it.
I feel like the first time I heard about this, I was in my 30s, so maybe 20-ish years ago. And I went, oh, that's a great idea, because I'm not super literate in this area. And I don't know when to be aggressive versus non-aggressive. And this sort of, if you trust the company and you trust the fund and they've got some historical background, this is a good way to go.
Well, here's the thing. So when you invest money, your philosophy changes as you grow in age and as your working years get closer and closer to coming to an end.
Or it should.
In general, you want to be a lot riskier when you're younger and get more conservative financially as you get closer and closer to retirement. So for example, the S&P 500, if you look over a 100-year period, I don't think it doesn't go 100 years back, but if you go back into the 50s, I think it is when it first started, if you just invested a bunch of money when it went in its first year in all those stocks, I mean, you'd be stupid rich. But was there a 5-year period where it went negative? Heck yeah. Right? So as you invest for retirement, the last thing you want to do is have a high risk of negative returns right as you're beginning to retire or in those first years of your retirement.
When income recovery is no longer really a thing.
Exactly. You're not putting more money into the market now, so you can't buy low anymore. You just have what you have, and you have to sell it when you need to pay the bills.
Mm-hmm.
So as you go through life, as you go through your career and your investment career, you want to start getting, in general, more conservative as you approach retirement. And then when you're in retirement, and there's all sorts of philosophies about what percentage of your money you should have in equities versus in bonds versus in cash. And
Right.
We're not going to go into providing recommendations, but what these target date funds do is they follow very basic rules for how conservative you should be getting as you approach retirement. So it does it for you. So you can buy one fund when you're 25 years old and say, hey, I'm going to retire in 40 years. So add 40 to when you start working. And you can just plow money into that theoretically. And every year that goes by, you are following the strategy set forth by that fund. It makes it easy. You don't have to make a lot of decisions. If you don't want to follow the stock market, if you don't want to understand a lot of the details,
but you
this is
feel
a pretty
like,
easy way to do it.
If you want to feel some sense of ownership and understanding for what you're doing, this is a really nice fund idea, in my opinion, because we all understand I want to retire at this point, and basic investment philosophy is you want to get more aggressive or less aggressive as you get older, and this does that. So I felt really good about it because I understood it. I understood what the fund was trying to do.
It makes the decision a lot easier. It gives you a math formula to follow. What year do you plan to retire? And if you actually dig into how they work in a little bit more detail, you can look at the curve essentially where it starts to convert percentage-wise from securities over to bonds more and more and more. And it does that in it's very distinct. They show you the years and what percentage you're gonna be at. If you decide, hey, I know I am going to retire in 2040, but I want to be a little more aggressive for the next 2 years than what 2040 is doing. So you could say, well, I'm going to sell the 2040 fund and buy the 2050 fund and hold that for,
or the opposite,
2 years, 5 years.
If you're worried about the political climate and you're saying, wow, I feel like maybe this is not a good time to have money in the stock market, I'm going to.
Yeah, so it's not like you're stuck. It's not like they look at your age and say, no, you're not going to retire in 2040. You're going to retire in 2045. So sorry, you have to buy this. There's no real rules behind it.
Mm-hmm.
So you can do whatever you want, but the point is you're not stuck in whatever the fund manager's thoughts are with that particular fund. You can just sell it and buy a different one. Okay, now let's cover some common terms, common phrases, things that are out there in the news, things you'll see on Yahoo Finance, the homepage, things you'll hear about on all your favorite news channels, and what it is they mean. I think everyone's heard of the stock exchange, right? Very basic term. Well, a stock exchange, think of it as a store where stocks are sold. There's the New York Stock Exchange. There's the NASDAQ exchange. There's the SIBO, the Chicago Board of Options Exchange.
And there's international exchanges.
There's international ones. The three big ones in the U.S. and NYSE, NASDAQ, and SIBO. So, and there's even more and more detail below that I won't get into. But these are where the stocks are sold. I say where, New York Stock Exchange. We've all seen where the stock market opens and they ring the bell, and a lot of times they'll have the celebrity there. There's a physical building on Wall Street where this exchange of stocks happens every day. They also have electronic versions of the New York Stock Exchange. So it's not all physical on the floor, but the NASDAQ is all electronic. There isn't a floor where people are throwing papers back and forth at each other like the NYSE. So that's where the stocks are sold. So every company has to get onto one of those exchanges.
Okay.
You sell your stock at one of those exchanges.
And by the way, I was today years old when I first saw SIBO. For those of you who are joining me, it's capital C, capital BOE. The
Chicago Board of Options Exchange, yeah. There's several exchanges below that feed up into that. That one's a little bit trickier, but essentially look at it as there's a Walmart, a Target, and a Lowe's. And you can buy stocks at any one of those three, and you got to be listed on one of those to be able to have your company sold on it.
Okay.
And you can be listed on more than one.
I was just going to ask that.
You can be, and when you go and you actually buy and sell stocks, you don't really know what exchange you're going to purchase yours or sell yours to.
Oh, you can't just go to the store and buy the stock?
No.
Okay.
Well, you could go to the New York Stock Exchange. You could go on the floor. You got to be licensed, and you could theoretically do that. I wouldn't recommend it, but
you got to wear a dress shirt, roll up your sleeves, and have your tie askew. I think that's uniform.
Yeah. So, when are you going to hear about the exchanges? You're going to hear about the exchange when they show some celebrity ringing the bell at the New York Stock Exchange. When they talk about how the market went way up today or way down today, they'll show pictures from the floor at the New York Stock Exchange and people with their heads in their hands or people celebrating.
Wardrobe.
But when you actually see the data, when they show the numbers on the screen, they're talking about the index or indices. So the indices are just categories where people lump stocks together.
Is that are you talking about the ticker?
The ticker, the stock ticker.
Okay.
Well, I mean, so like when you hear something like the S&P 500, for example, that is an index. It's basically a clique, a friend group. They're just grouping those together in some meaningful way.
It's a non-annoying group chat.
The S&P 500, what is that? It tracks the 500 largest U.S. companies. It's market cap weighted, giving large companies more influence on performance. So, for example, it's not the 500 companies, each one of them doesn't get 1/500th of what the S&P 500 total number will end up being for the day.
But there's some cachet to being on that list, I'm assuming.
Well, sure. I mean, it's
the popular click, and I'm guessing there's movement on there. I'm guessing some companies come on and go off. Or is
of course.
Okay.
No, yeah, it happens all the time. So Apple, Microsoft, Walmart, those are three of the top S&P 500 companies that you might know. In fact, there's a lot of negative attention on the S&P 500 these days because some of the larger companies are such a high percentage of the S&P 500. It used to be like a nice mix, like you really know what's going on in America with American companies if you follow the S&P 500. But when the top 5 companies are more than half the percentage of the S&P 500, that can become a problem.
Earnings, you mean?
No, it's not the earnings. It's the market capitalization, so the value. So again, I said there's 500 companies in there. One of those companies might be worth 50 times the value of another one of the companies that's in there. So when that stock goes up or down 10%, the S&P 500 goes up and down a lot more than if the small company went down or up the same percentage value.
And splitting your stock doesn't impact that, right? Because the overall value of the company maintains its...
That's correct, theoretically, yes.
Okay.
Yes. So, for example, the S&P 500, the top 10 companies account for over 38% of the total market cap.
So
it's just something to know, right?
Yeah,
it's something to be aware of.
Yeah. Maybe not a problem today, but you could see maybe depending on the industries that are represented in those, maybe some volatility.
Okay, so S&P 500, that's an index. The next index I'm going to talk about is the Dow Jones Industrial. We've all heard about the Dow. When people say the Dow's up, the Dow's down, what they're really talking about 99.9999% of the time is the Dow Jones Industrial Average. Companies like Coke, McDonald's, Johnson & Johnson, the so-called blue chip companies. So blue chip company, what is that? It's a high quality, industry leading business known for consistent earnings, strong balance sheet. This is your grandpa and your grandma.
I was just thinking
done
blue
everything
chip,
correctly.
blue hair.
Yeah, they always seem to do things correctly, right? And they never make too much money, but they're always making a little bit of money. That's your Dow Jones blue chip style company.
Okay.
Then there's the Russell 2000. Russell 2000 is small cap companies, so it gets you a little bit more of a look into smaller companies, which is another way of saying companies that have a lot more opportunity for growth, hopefully, is the reason why you follow the Russell 2000. You're looking for the next NVIDIA, the next Microsoft.
Mm-hmm.
Microsoft isn't going to, their stock isn't going to increase by 100% anytime soon.
Right. And I'm looking at one of the company names in that list, and that's Carvana. So I'm thinking, okay, Carvana, wow, that's
Crocs, Carvana.
It's really done some things, but as Carvana's business example becomes more known, there's going to be more opportunities for us to have choice and not have to use Carvana. We could use this other company instead.
And that's what eats into growth.
Yes.
Looking at another example of that would be Uber and what's the other? Lyft.
Lyft. Yeah.
I think Lyft was first, right? I think Lyft came out first, and then Uber came out and just totally, pretty much destroyed it. Now I think it's a little bit more even.
Yeah, I don't know.
Yeah.
Well, Uber's taken a recent hit because of the some of the court case things that have come out.
Yeah.
Yeah.
And the last index I want to talk about is the NASDAQ, and I'm saving it for last for a special reason. So the NASDAQ, some of the NASDAQ companies, NVIDIA, Amazon, Meta, which is now, the new name for Facebook. It is the tech companies in general. The reason I saved it for last, if you're paying attention, taking notes at home, I mentioned all the exchanges, the New York Stock Exchange, the NASDAQ, the SIBO. And now we're talking indices. We're saying S&P 500, Dow Jones, Russell, and NASDAQ. So NASDAQ is, depending on what you're talking about, it is an exchange and it's an index. It's both of them. Okay. It's actually two different things with the same name is maybe a better way to say it.
Well, that's a crappy thing to do.
Well, and there's a reason, again, there's always a reason for that. So the NASDAQ, it's the tech exchange. It became an index. So the exchange and the index in this case are synonymous, really. When you hear NASDAQ, you think technology. However, some companies like Apple and Microsoft, they're sold through the NASDAQ exchange, but they're also part of the S&P 500. So Apple and Microsoft, if you're buying an S&P 500 fund or a NASDAQ index fund, which the main NASDAQ index fund is every company that's sold on the NASDAQ exchange. Then there's also the NASDAQ 100, which is the top 100 companies sold on the NASDAQ exchange. And when you watch the news and they tell you the NASDAQ did something, they're talking about the NASDAQ 100.
Okay. So I have a question about the exchanges. So New York Stock Exchange, NASDAQ, SIBO, these are all American exchanges.
Yes.
Are all the companies traded on these exchanges American companies?
There are many foreign companies that are included in American stock exchanges.
When I was teaching my personal finance class, all of my students were fascinated that I was an Android girl and I had a Samsung phone. And so we then looked up Samsung stock to see what it looked like compared to Apple stock. And lo and behold, Samsung stock is not traded on any American exchange. It's traded on the Korean?
Yep.
Okay.
South Korean.
South Korean.
To be specific.
Let's be specific, yeah.
Yes. Thank you for joining us today on the Retirement Outsiders podcast. Please remember to rate, like, and subscribe on Spotify, YouTube, or wherever you listen. Thanks again, and we hope you'll join us next time on the Retirement Outsiders.